Hi, good morning again. We wait another like 1 minute. We wait another 2 minutes. We wait another 2 minutes. Let everybody to join. Good morning again. We wait another 2 minutes. Good morning. Eda. Today we do a financial statement. You all can download the worksheet from this link. You all can download worksheet from this link. Okay, this year-end adjustments is very, very important for your future topics. Okay, for year 11 future topics, you must understand this year-end adjustments. So I will explain what are the year-end adjustments that we have. After that, we will do one question. We do only one question. Okay. So before that, let me explain the year-end adjustments. Okay. You see, the accounting cycle. Accounting cycle will start with document. All these document will be recorded in a book of prime entry. We have 7 book of prime entry. Okay, document example of the document. Wait, give me 1 minute. Example of the document is okay. Example of document is invoice, not debit note, credit note, receipt, bank slip. What else? Bill. All these are documents. These documents is the proof of the transaction. Documents is a check counterfoil, all these are documents. Okay, so documents is the proof of the transaction. When a transaction happen, what we do, we take the documents as a proof and we will record in the book of prime entry. All the transaction with the proof of the document, we will record inside the book of prime entry. Once we record it in the book of prime entry, okay, before that, how many book of prime entry? There are 7 book of prime entry: sales journal, purchasers journal, sales return journal, purchasers return journal, cash book, petty cash book, and also we have journal. So these are the 7 book of prime entry. All this recorded, all the things will be recorded in a book of prime entry. All the record in a book of prime entry will be transferred to ledger. Will transfer to ledger. In a ledger, we have 3 ledgers. One is the nominal ledger, sales ledger, purchasers ledger. Very good. Sales ledger, purchasers ledger, and nominal ledger. Okay. Sales ledger to record all the trade receivable, purchasers ledger to record all the trade payable, and nominal ledger is other accounts other than trade receivable and trade payable. And also, additionally, there will be another account in a nominal ledger, which is the sales ledger control account. Purchasers ledger control account will be inside the nominal ledger also. Sales ledger control account and purchasers ledger control account. Okay. After we prepare the ledger, and then we will prepare the trial balance. Okay. In a trial balance here, we prepare the trial balance. Prepare trial balance, and also we will do the correction of error. If you got any error, we'll do the correction of error here in a trial balance. Okay. After that, we will transfer to these balances in the trial balance will be transferred to financial statement. Anybody know we have how many financial statement? But actually, we got 5. Okay, so far you learned 2. So far you learned 2 only. In the future classes, in a year 11, we will learn more financial statement. Altogether, we have a 5 type of financial statement in accounting, but later you will learn one by one. Okay, for now, yes, you learned 2 already, which is the income statement and statement of financial position. Another 3 in a future we will learn. In the future we'll learn. Okay, so financial statement, there are 2 financial statements so far, 2 financial statement, which is the income statement and statement of financial position. Understand? So in between here, from the trial balance to the financial statement, there are something else. There's one thing, which is the adjustments. So the figures or the numbers in a trial balance, actually not really updated or not really correct figure. Okay, not really a correct figure, not really an updated figure. So what accountant, who will do this? The bookkeeper will do this. The bookkeeper, the clerk will do this. Okay, the adjustments, they don't know how to do adjustments. So the accountant don't do the adjustments. Accountant will tell the bookkeepers to do the adjustments. Then the bookkeepers will do. With the guidance of the accountant, bookkeepers will do the adjustments. Then only accountant will do the financial statement. Accountant will do the financial statement based on the adjusted trial balance. So this trial balance here, TB is trial balance, yes. TB is trial balance. So the figures in the trial balance is not updated. Why not updated? I can give you some example. The prepaid expenses, prepaid income, accrued expenses, the depreciation, provision for doubtful debt, all these things they haven't record here. Why they don't record the provision for depreciation? Why they don't record the e-recoverable debt here? Okay, because for depreciation, for provision for doubtful debt, all we don't have a document. We don't have a supporting document says that how much is your depreciation, how much is your provision, how much is the e-recoverable debt. Okay, if you got a proof, then you will record. But if you don't have the proof, we don't record in the ledger. So when we will record, is it depreciation happen? Yes, it's happened, but we don't have the proof of the document. We don't have the document to record to shows how much the depreciation. So all the depreciation, provision for doubtful debt, e-recoverable debt, and anything also we prepaid and accrued expenses will be adjusted under the adjustments before you prepare the financial statement. You understand or not? So I show you the question. The question is here. So this is the trial balance. This is the trial balance. But some, not all, I'm not telling all, some of the figures here is not updated. It's not updated. It's not the right figure. Okay. Why? Because they haven't include these adjustments. We haven't include the adjustments. So what we need to do, we need to update this trial balance. We need to do the correction, or we need to add on. We need to add on, or we need to update the trial balance, and then using the updated trial balance figures to do the income statement and also statement of financial position. So now, do you understand what is the purpose of the adjustments? Who still don't understand what is the purpose of adjustments? Because if you didn't adjust, okay, let's say you don't want to adjust this. You want to take these figures from ledger account, these figures from ledger account, straight away want to do the financial statement. Then you calculate in an income statement, you calculate the profit. Do you think this profit is correct? No, because you are taking the not updated figures, not the latest figures, not the correct figures. So some of the figures here is not correct, not updated. So we as an accountant make sure we take the right figure so we can calculate the perfect profit. Perfect profit. So that's the main purpose of adjustments. Any mistakes, any not update things, we need to update first before we prepare the financial statement. So you understand? What is the purpose of adjustments? Okay, if you no question on the adjustments, here I list down altogether seven plus this one, correction of error. All the 7 adjustments plus with 1 correction of error. Correction of error also I included in the adjustments because all this will happen on the same day actually. All this, the adjustments of the trade receivable, trade payable, adjustment of the depreciation, everything, and correction of error also will happen on the same day. Accountant will do the same time. So that's why I included the correction under the adjustment. Okay, but it's actually under the trial balance. After you prepare the trial balance, you'll do the correction and adjustment, something like that. After you prepare the trial balance, you will do the correction if you got any correction, and also you do the adjustments before you prepare the financial statement. So altogether, we're going to discuss 8 main things, and I want you to remember all these 8 because after Chinese New Year, we're going to focus on these adjustments almost all the chapters. Okay, the chapters after the Chinese New Year is after chapter 16. After chapter 16, all the chapters we need to know these adjustments that we learn in a year 10 actually. All these adjustments we already learn in a year 10, but the chapters after chapter 16, 17, 18, 19, 20, 21. Yes, 22 no need. 22 no need, we no need these adjustments. So 17 until 20, all these 5 main big chapters, very length chapters need this year-end adjustments. If you don't know the year-end adjustments, it's very hard to answer the questions from these 5 chapters. Okay, so we'll see one by one. The first year-end adjustments, we will adjust on the inventory, closing inventory. As I told you, whenever you buy inventory, you record in a sales journal. If it is a cash, you record in a cash book. Sorry. If you buy means purchases journal and also cash book. If you sell, you record in a sales journal and also cash book. And then you open in a sales account, purchases account. then you transfer to this trial balance. But anywhere in this account here, did you show how much is your closing inventory? Any of this account, did you show how much is your closing inventory? Whenever you buy inventory, you record in the purchases. Whenever you sell inventory, you record in the sales. But there's no inventory account. We don't open an inventory account in the ledger account. So end of the year, before you calculate the profit, you need to know how much is your closing inventory. So the first adjustment that we will do is we will calculate, or we will come up with the closing inventory. That's the first thing that you need to do. That's the first thing that you need to do. You need to calculate how much is the closing inventory. Understand? Huh? Okay. If you are not clear, I mean, if lagging, or if my voice is not clear, please let me know. I will change my place. Okay. Now this room is very far from the Unify. If I'm lagging, or if you cannot hear me clearly, please let me know. I will go to the closest place to the Unify. Okay, that adapter lah. Okay, the first one is a closing inventory. Always remember, if the question give you two closing inventory, always take the lower value. If the question give you, regardless it's a net realizable value or cost, regardless it's net realizable value or cost, we will take the lower value, because we prudent. We don't want to overstate our asset. We don't want to overstate our profit. So closing inventory, always take the lower one, because we are prudent. Okay, if the question give you net realizable value 800, the cost of closing inventory is 1,200. Which amount do you take? Very good. Okay, so you'll take the 800. We just don't care about the cost. We'll take the 800 net realizable. Regardless it's net realizable value or cost, whichever lower value, we take the lower value. Okay, this closing inventory will be recorded where? This closing inventory, normally in a financial statement, we record in two places. Okay, before that, let me clarify the financial statement. Income statement, we have sales or revenue, cost of sales, other income, other expenses. These are the four sections that we have in the income statement. In a statement of financial position, we have non-current asset, current asset, capital, non-current liability, current liability. We have a 5 section in a statement of financial position. Understand now? In the income statement, we have a four sales, cost of sales, other income, other expenses. In a statement of financial position, we have a non-current asset, current asset, capital, non-current liability, and current liability. These are the 5 things we have. Okay, now? Okay, now, this closing inventory will be recorded in 2 places. One, in a cost of sales. In the cost of sales there, the closing inventory, we record there minus the closing inventory here. Actually, we minus from the closing inventory, and then we record where? We record in the inventory account. So the closing inventory will become your, very good, current asset. So these are the 2 places that we record the closing inventory. One in a cost of sales, another one is current asset. The closing inventory will be recorded in 2 places. One, cost of sales, another one is current asset as a closing inventory. Both places also closing inventory. Cannot? Any question on this? Anything that you don't understand, please ask me. The first year-end adjustments on the financial statement. Okay, next one. Next adjustments is about income. Next financial year-end adjustment in the financial statement is income. Income. Prepaid closing. Prepaid closing, you plus or minus. Closing, I'm talking about closing. Prepaid closing, you plus or minus? You know, you don't know. If you don't know, just say don't know. If you don't know, please say don't know. I will explain. Okay, I get a mixed answer. If you don't know, you copy this. I think I copy here lah better. Prepaid and accrued. Prepaid and accrued. We have two prepaid and two accrued. One is the balance CD, which is the closing, and another one is BD, which is the opening. Okay, we have a prepaid on the opening, prepaid on the closing, accrued on the opening, accrued in the closing. So your prepaid closing, prepaid closing, prepaid means you pay extra. You pay for next year in this year. It's not for this year. It's for prepaid means it's for next year, or you receive for next year. It can be received, it can be paid. Both also can. Prepaid means it's for next year. So we minus for closing. So opening is from last year's come to this year. So this year we will plus. Prepaid closing will be minus. Opening will be plus. But now for year-end adjustments, year-end what? Year-end adjustments, we don't talk about opening lah. We don't talk about opening. We're talking about the closing. We're talking about the closing. So year-end, at the end of the year, we prepaid, we minus. Yes, correct. Okay, similarly, accrued closing. Accrued closing. Accrued means you haven't paid or you haven't received, but you're supposed to receive. It's for this year. You're supposed to pay. It's for this year. You didn't pay or didn't receive, regardless of payment or expenses, but it is a payment or receive, but it's accrued means end of the year, we plus. End of the year, we plus. Beginning of the year, we minus, because it's not for that. Beginning means it's for last year, right? So our closing means it's for this year, so we plus. So can you remember this? This is very important. Definitely will come out in IGCSE, this concept. In a paper 1, in a paper 2, anywhere, definitely will come out. You must understand this concept and remember this concept. It's applied for the income and expenses, both also. Income, expenses, both also, we use this concept. Prepaid closing minus accrued closing plus. You just remember for closing. For opening, it will be the other way around. Just can remember like that. Okay, it's quite important. Huh? Okay, I see some of the students just joined. The student who just joined, you all can download the today's worksheet from this link. If the link is not working, please let me know. I will send you again. Okay. Okay, please remember this. Prepaid closing minus, accrued closing plus, opening the other way around. So now come back to this. Everyone, please answer me. Prepaid closing, add or minus? Very good. Everyone following me. Minus. Prepaid closing will be minus. Okay. Prepaid income. What is a prepaid income? Prepaid income. Wait, Income, prepaid closing means prepaid income. Prepaid income means you over received. Prepaid income means you over received. If it is over received, you owe that guy or that guy owe you. If you over received, you owe the guy or that guy owe you. Very good. You owe that guy or that guy owe you. Wow. That guy, you over receive from the guy. You over receive from that guy, and then the guy owe you. Wow, so smart are you? Okay, there's only one student say. Okay, good. We owe the guy. I owe the guy. If I owe the guy, we owe the guy, it's my current liability. It's my current liability. Understand not? Okay. Accrued closing. Accrued closing is haven't received. Haven't received. Accrued closing is you haven't received. Supposed to receive, but you haven't received. So since you haven't received, we plus or minus? We plus because it's for this year, but we haven't received means haven't record. Haven't record means we need to record. So plus. We need to plus. And then if I supposed to receive from the guy, but I haven't received. I supposed to receive from the guy, but I haven't received. So that guy owe me. If that guy owe me, it's my current asset. Can you remember this? All this. You must remember this. It's not can you. You must remember all this. Because after this, we're going to use this a lot of chapters. Okay, similarly, expenses. The third adjustment is adjustment on the expenses. Adjustment on the expenses. Okay, which one is opening? Which one is closing? How I remember is C. C is what? C is closing. Okay, CD, C is the closing. The B is opening. BD is opening. BD is opening. CD is the closing. Okay, example number 3. Adjustment number 3, expenses. Prepaid closing. What is a prepaid closing means? Prepaid expenses. What is prepaid expenses? You overpay the guy. If you overpay the guy, we will minus from this year's income expenses. Why we minus? Because it's not for this year, it's for next year. So we minus. But then since we overpay the guy, so now I owe the guy or the guy owe me? Now I owe the guy or the guy owe me? I overpay the guy means that guy owe me. If that guy owe me means it's my current asset. Very good. If that guy owe me means it's my current asset. Accrued closing expenses. Expenses accrued closing means you haven't paid. You're supposed to pay, but you haven't paid. Maybe you don't enough money or you know time to pay. I don't know why, but it's accrued means you haven't paid. Supposed to pay, but haven't paid. So it's supposed to pay, but you haven't paid. Since you haven't paid, they haven't record. Since you haven't paid, they haven't record. But it's for this year. It's for this year, but they didn't record. So what we do? We will plus to it. We will record. Okay, regardless you paid or not, but I want to know how much the total expenses for the month, regardless paid or not. So since I haven't paid, they haven't record. So since I haven't record, I will record for them. Okay, we plus. Then since I owe the guy, I supposed to pay, but I didn't pay. I supposed to pay, I didn't pay. So I owe the guy, it's my current liability. Okay, I give you 1 minute. Can you try to digest this income and expenses? Digest this, then we'll continue. Any question, ask me. If you don't understand anything, please ask me. Yes, after this class, after this thing, I will record this and send in the group, send in the WhatsApp group. Very good. Roti canai only fill your stomach, but accounting will fill your body, fill your love, fill your brain, everything will be filled. You need to digest. Yes, fill your bank also in the future. Accounting fill my bank now. So in the future, it will fill your account, your bank account also. So make sure you spend more time with accounting rather than maths. This class is recording. I cannot say anything. Okay. Okay. Good subject. Continue the lesson. Okay. Next one is irrecoverable debt. What is the next adjustment? Is irrecoverable debt. What is irrecoverable debt? I supposed to receive, but I cannot receive. I won't receive. Not cannot, I won't receive because maybe the guy bankrupt or the guy run away or the guy die already. Something happened to that guy. Something happened to the guy. I cannot get back the money, the debt that the people owe me. Lah. I cannot get the money. That's the irrecoverable debt. Normally on the here, okay, after we will prepare the trial balance and then we will take back our list of list of the trade receivable. Take list of the trade receivable, then we will call them and try to contact them. Lah. So who are the people definitely not going to pay us? So if you're sure the guy not going to pay us because of bankrupt, die or something happened to the guy, so we will adjust the debt as an irrecoverable debt. We will adjust the debt as an irrecoverable debt. Okay, so whenever there is an irrecoverable debt, anywhere you see the irrecoverable debt, then they ask you to record. They ask you to record the irrecoverable debt. What you can do, what you need to do is you need to go to the expenses. In an income statement, other expenses there, you need to plus not plus, you need to record as a irrecoverable debts. In expenses, you record as a irrecoverable debt. After that, you go to the current asset. You go to the current asset, go find your trade receivable. Go find your trade receivable, you minus the trade receivable. First, you go to the expenses, record as an irrecoverable debt. Go to the expenses, is your loss. Loss means your expenses. You record as a irrecoverable debt. Then go to the statement of financial position. Under the current asset, you go find the trade receivable. You minus how much is irrecoverable debt. Can you remember this? Okay, whenever the guy die or run away, we plus our loss, which is the expenses, minus his debt. Trade receivable will be minus. Okay, the fifth one is, that one nothing much, very easy. Fifth one is debts recovered. Debts recovered is, the next adjustment is debts recovered. Debts recovered means the guy who ran away from you last time, maybe after 1 year, after 3 years ago or 4 years ago, the guy come back and pay. Sometimes the people who run away, why they so good come back and pay back the debt? Because they want to clear their name. Once you sue them and then you go to the court and then blacklist them, they owe us, right? So before we record as an irrecoverable debt, it's up to you lah. If you want the guy to suffer, if you want that guy to suffer because the guy owe you, then the guy didn't pay you, right? You angry. Some people, they're very kind. They just minus in the book and then they silent. They don't do anything. But some people, they minus in their book. But before they minus in the book, they go to the court. Okay, they will sue the particular company and make them bankrupt. So when they go bankrupt because of you, they need to come back and pay you back your money so they can clear their name. So some people, whoever run away, whoever go bankrupt, they will come and they will settle with you. They'll come pay back the money that they owe to you to clear their name so they can start a new business. They can start a new business. Okay. So where to record? We record in a bank or cash. Bank or cash will be plus lah because we receive money, right? When we receive money, bank or cash or whatever money, whatever thing that the guy give you. Sometimes the people don't want to pay cash. They have no money, but they have a house. They give you their house, or they have their car. They give you the car. So we plus that particular asset, whatever they gave. And then we will go to this one will be current asset. This one will be under the current assets. And then again, in the income, we will plus our debts recovered. We record as a debts recovered is our income. Whenever the guy who ran away come back and pay, we will record it as our income, debts recovered. Can or not? Any problem? Okay. Yes, revenue is the income, same. Revenue is the actually main income. Other income is other income, all same. Okay, irrecoverable debt and debts recovered. Any problem on this? We already discussed 5 adjustments. Okay, next one, the 6th one, PDD, provision for doubtful debt. PDD or PFDD lah, provision for doubtful debt or provision for doubtful debt or doubtful debt, same thing lah. Okay, PDD or PFDD. What is a PDD? Estimation of trade receivable debts that cannot collect, or estimation of the trade receivable debt that will become irrecoverable. It's an estimation. It's an estimation. Cannot collect or irrecoverable debt. Irrecoverable debt. Okay, so first you need to know how to calculate the provision for doubtful debt. First, you need to know how to calculate provision for doubtful debt. So the formula is you take your trade receivable. Okay, it's a net trade receivable. What is a net trade receivable? Anybody know? Sorry. What is the net trade receivable? Net trade receivable is a trade receivable after you minus all your irrecoverable debt. Net trade receivable is the trade receivable that after you minus all your irrecoverable debt. So if you know the guy definitely not going to pay you, we just exclude that. Okay, we just exclude that, or we can call that total trade receivable that we will receive lah. Okay, from that net trade receivable, because it's estimation of the PDD, right? If the guy definitely not going to pay, you no need to estimate. The guy definitely not going to pay. Just exclude the guy. The guy is as loss. So this one is the one that will pay, but you still have a doubt. So you take the net trade receivable times with the percentage. You'll get the provision for doubtful debt. You take the net trade receivable times with the percentage given, and normally the percentage cannot more than 10%. 10% is too much already actually. Normally it will be like 2-3%. Okay, acceptable. But if a 10% more 10 or more than 10 is your company is very bad. You need to work on the credit control. You know what's credit control, right? How you managing the trade receivables debt. Okay, so whenever you sell to people on credit, what you need to do? First, you must send the invoice. Okay, invoice is to inform the guy that you owe me this much of money. Then after 1 month, we send statement of account. Remind the guy, oh, you owe me 1 month already. So after 6 months still didn't pay, you send an email, you call them, you go to the office. All these are credit controls. We need to improve our credit controls if your provision or e-recoverable debt is too much. So we need to work on that. Okay, so this is a provision for doubtful debt. The formula to calculate the provision for doubtful debt is you take the net trade receivable times with the percentage, Then how to record in the after you calculate, you need to compare with the last year's one. Okay, if it's increased, the record is different. If it's decreased, the record is different. Understand? Okay, so if it is an increase from I'm comparing with the last year. If your PDD increase, it will be my expenses. If your PDD decrease, it's my income. Understand not? If my PDD increase, is my expenses. If my PDD decrease, is an income. Because PDD is not a good thing. PDD is not a good thing. If a not good thing decrease means it's a good one. Okay, so it's income. Yes, PDD decrease means it means your economy become better. Okay, everybody in a good situation that so they can pay us the debt. So it's a good news. Yes. Okay, but PDD increase means economy going bad, everybody going to go bankrupt, something is not good. Less PDD is better, yes. Yes, of course, if you reduce the debt, is good one. Getting the money. Okay, so how to record? Whenever PDD increase, it's your expenses. So first you go to the expenses. You record increase in provision for doubtful debt. Increase in provision for doubtful debt. Then you go to the current asset. Under the current asset, you'll have a trade receivable, right? Don't disturb the trade receivable. Under the trade receivable, you need to record one new thing called provision for doubtful debt. Then you record here. Understand? Yeah. Any question? If you don't understand, please tell me. I will give you an example. If you don't understand, please tell me. I'll give you an example. Okay, next one is provision for doubtful debt decrease. If your provision for doubtful debt decrease, it's your income. Decrease means it's your income. Then in a debit, we write, oh, sorry, not debit credit, not debit credit. We write income. Go to the income, we write decrease in provision for doubtful debt. Provision for doubtful debt. After that, same, you go to the current asset. Go find your trade receivable. Don't do anything trade receivable. Under the trade receivable, there will be a provision for doubtful debt. So you'll record that in a provision for doubtful debt. In a current asset, the record is still same now. In a current asset, the record is same. Okay, I'll give you one example. compare with the last year. Last year, let it be in a trial balance. In a trial balance, the last year PDD. This the whatever the trial balance in the last year's PDD may be 100. This is the last year's PDD. Okay, and this year you calculated. Okay, PDD increased by 20. Let's say increase by 20. So what do? You go to the expenses, you record 20. You record 20. And then in a current asset, you write how much? 120. You understand? Okay, let's say the same example. Your trial balance last year is 100 and it's in decrease by 10. It's decreased by 10. So in income, you write 10. In your provision for doubtful debt in a current asset, you write 90. Do you understand how I get 90, right? Last year 100 minus with the 10, I get 90. And last year 100, I plus with the 20, I get 120. If it is increase, we plus and then write in the current asset. If it is decrease, then we minus, record in the current asset also. The record is same, but the amount will change according to the increase or decrease. Okay, I give you another 1 minute. Try to digest this provision for doubtful debt before we move on to the depreciation. I give you 1 minute. You just read and try to understand. Any problem, anything that you don't understand, please ask me. I give you. Yes, TB is a trial balance. TB is a trial balance. Any problem? Can I move on? You all okay, ready? Okay, next one. Depreciation. Depreciation, how to calculate the depreciation. There's a three method. Now there are three methods to calculate the depreciation. Straight line method, reducing balance method, revaluation method. There are three methods. We have three methods to calculate the depreciation. Wait on. The seventh adjustments is depreciation. The seventh method is depreciation. Okay, how to calculate the depreciation? First one is straight line method. Okay, another name for straight line method, sometime they will say on cost. Okay, sometimes they say on cost, straight line, on cost, all these are same thing actually. The formula to calculate the straight line method is you take the cost times with the percentage. But sometimes if it is we can calculate the depreciation in a two way. One is the full year depreciation. So full year means this the formula, cost times the percentage. It's a full year. But sometimes the question will ask you to calculate monthly. Sometimes the question will ask you to calculate monthly. When the question asks you to calculate monthly, you need to times with how many months over 12. How many months the asset is used during this year, only for this year. We are within this year, the 12 months, out of the 12 months, how many months we used the asset. Okay, but this one, when the question asks you to calculate monthly depreciation only, we calculate like this: how many months you use, then we divide over 12. Okay, if the question say a full year, the question will tell you, the question definitely will tell you, you need to calculate a full year depreciation or monthly depreciation. Then if monthly means, we need to do the green. If they didn't say anything and they say full year, then we go for blue, only times the percentage. 10. Next one is reducing balance method. Reducing balance method is, it's on book value. It's on book value. Okay, sometimes the question will say book value, sometimes they say reducing balance. We just follow lah, whatever the terms they use. Okay, what's the formula? We take the cost minus with accumulated depreciation. Cost minus accumulated depreciation times with percentage. Cost minus accumulated depreciation times with the percentage. Okay, but another thing, please get to know this also. Cost minus accumulated depreciation. Cost minus accumulated depreciation is book value lah. It's a book value. Cost minus accumulated depreciation, we'll call that book value. So take the book value times the percentage, you get a depreciation for 1 year, full year. If the question asks you to calculate monthly, then you need to times with how many months over 12. Same thing. X is the how many months that you use the asset in this year, during this year. Within the 1 year, how many months? Can or not? Okay, next one. Where do we record this? How do we record this? You go to the expenses, record as a depreciation for this year. Whatever that you calculate. Okay, depreciation that you calculate this year, you record here. Only the current year's depreciation, whatever that you calculated here, whatever that you calculated here. Then go to your non-current assets. Under the non-current asset, we will have a cost. Don't disturb the cost. Okay. Then there's a provision for depreciation. Provision for depreciation. we have here. And how to get this one? This one is last year depreciation plus with this year depreciation. Last year depreciation plus with this year's depreciation. Understand not? Last year you'll get from trial balance. Last year one you get from trial balance plus with this year's one you record here. Yes. Current year depreciation is this year's depreciation. Current year depreciation is this year's depreciation. You plus together. Cannot. This one, the first two method, straight line method and reducing balance method. The next one is revaluation method. Okay, how to do the revaluation method? It's different from the other two methods. This is different from other two methods. We take the opening cost of the asset plus with purchase cost of the asset minus with sold cost. The cost on the cost of the asset that you sold minus with closing cost of the asset. You will get the depreciation. Opening cost of the asset plus purchase cost of the asset. All these assets now, NCA, 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 NCA. Then you'll get the depreciation. Opening cost of the asset plus with the purchase cost of the asset minus the sold cost of NCA, minus with the closing cost of the asset. Then you get a depreciation. Then how do we record this in our account? How do we record in the account? First one, we go to the expenses, record the depreciation. This is the current year depreciation. Then, listen carefully, this is slightly different than the previous two method. You go to the NCA, non-current asset. Go to the non-current asset, go find your cost. Minus with the current year depreciation. Okay, for revaluation method, we never have provision for depreciation. For revaluation method, you cannot have a provision for depreciation. We straight away minus the cost. Then that's your answer will be recorded in your statement of financial position. Answer not. It's slightly different than the previous method. Provision for depreciation. If you see the previous question, previous method, we have provision for depreciation. We show as a provision for depreciation. We go plus here, right? Last year plus with this year's one, we show here, right? But for revaluation method, we don't have the provision for depreciation. We straight away minus the cost. Then we write the final figure in the statement of financial position. That's how we do for revaluation method. Okay, question number 8. Or not question number 8, the adjustment number 8. Adjustment number 8 is this one lah. Error, correction of error. Okay, correction of a simple errors. Okay, example of the errors here, a purchase of fixtures and fitting during the year 2000 had been recorded in a general expenses account. Where to record this? What to plus, what to minus? Can you tell me? Hey, this one very easy. The non-account student also can answer this. Where to plus, what to minus? Hello, anybody home? What to plus, what to minus? Plus the expenses, no. Read the question carefully. You see, you buy what? You buy the fixtures and fitting, but you mistakenly recorded in a general expenses. It's your fixtures and fitting, but mistakenly recorded in a general expenses. So what do? You go to the expenses. Excuse me. You go to the expenses. You minus general expenses. Then you go to the non-current asset. Plus fixtures and fitting. Okay, they mistakenly put in a wrong account. So you take out, put in a right account. That's it. Okay, next one. Next mistakes. I give you another mistake here. Loan received 200,000. Or not 200,000, 20,000. Loan received 20,000 had been recorded in the capital account. So can you tell me what to do? $20,000. Plus the bank. No bank here. No bank here. That's why you people didn't read the question fully. You just see the few words and then you answer. Loan receive or loan receive means bank. No such thing. You read the full question slowly. Understand the question before you answer. The loan received 20,000 had been recorded in the capital. It's already recorded. So they already plus the bank and then they supposed to go to loan. They go to the capital already. Yes. So what do you need to do? You need to take a capital. You need to plus the capital or minus the capital. You go to the capital, minus the capital. Minus the capital. Then you go put where? You go put in a, you go to the non-current liability. Non-current liability, you go to the loan, you plus the loan 20,000. Minus the capital plus the loan because it's supposed to be loan, but they mistakenly put in a capital. So you take out from the capital, put in a loan. That's a correction. We are doing correction. No current asset here. Okay. So you people just look at this one and then you tell me bank and that and this. You people did. Okay, that's the thing. You need to read the question very carefully. Don't assume anything. In accounting, you don't need to think out of the box. Accounting, you no need to think out of the box. Everything will inside the question. You just read the question and then answer the question. Don't think like, don't imagine other things. That's it. Okay, these are the 8 adjustments that you need to know. the sample of the 8 adjustments: closing inventory, adjustment on the income, adjustment on the expenses, recoverable debt, okay, debts recovered, provision for doubtful debt, depreciation, and also correction of error. These are the 8 things that you need to know. Based on that, we will do the financial statement. In the future chapters also, we need these 8. We need these 8 things. Okay. So now we will do one question very fast. Wait. We'll discuss the adjustment first. If we got extra time, then only we do the statement lah. So I want you to understand the adjustment first. Surya is in a business as a sole trader. The following balances were extracted from her book on 31st March 2016. So these are the balances they gave me. And then this is the additional information. Okay, they gave me 7 additional information. And then actually they asked me to do prepare the income statement and prepare the statement of financial position. These are the 2 things that we need to prepare. Okay. So I give you another 1 minute. I want you to read the additional information. Just read only. Then I will explain. I give you 1 minute. You just read the additional information. Then I will discuss. So can you just read? Give you one. Just read. Read ready? Can I discuss? Read all the 7. Okay, first one. Inventory was valued at 17,990. So this is the closing inventory. Closing inventory, my advice, you write in the 2 places. So go here, right? Closing inventory, write 2 times. Then only you won't forget whenever you record. Closing inventory, write 2 times. How much? 17990, 17990. That's a closing inventory. Okay, next one. Commission receivable outstanding. Okay, what is outstanding? Another name for accrued. Another name for accrued is outstanding. Another name for accrued is the outstanding. If you see the word outstanding, is accrued. Or another name is due. Due also is accrued. So outstanding means accrued, and it is 31st March. 31st March means a closing. 31st March means closing. So commission receivable accrued. plus or minus? Others? Commission receivable closing closing accrued. Closing accrued will be plus. So can you go find a commission receivable? Commission receivable, you plus 1,400. You plus 1,400. And then go create a new account called commission receivable accrued 1,400. Commission receivable accrued 1,400. Can or not? Okay, next one. Third one. Advertising included a payment of 5,700 for a series of advertising being published in a 6 months ending 31st July. Wait, today's date is 31st March. We are doing accounts until 31st March only. We are doing accounts until 31st March only. But then this advertising payment is until 31st July. It means you overpaid or underpaid. Very good. It's a prepaid, but you need to know prepaid for how many months. You need to know prepaid for how many months. April, because you close your account on March, right? April, May, June, July. April, May, June, July. 4 months. Okay. Prepaid for 4 months. So how much is your prepaid? You need to calculate. 5,700 for 6 months. 5,700. I write here. Advertising prepaid. Advertising prepaid is 5,700 divide with 6 times 4. Okay, wait, let me calculate. 5,700 divide 6 times 4. I get 3,800. Let me double check. 5,700 divide 6 times 4. Yeah, 3,800. Then go find your advertising prepaid. So advertising, go find your advertising minus 3,800. Because prepaid we will minus. Prepaid we will minus. Understand? Yes, it's a current liability. Later we no, it's a current asset. It's not a current liability, it's a current asset. Advertising prepaid means you pay extra. Okay, if you pay extra, it's expenses prepaid. Expenses prepaid is a current asset. Later, whenever we prepare the current asset, we'll put in the current asset. Yes, we overpaid. We need to pay until March only, but we paid until July. So overpaid, prepaid, we pay. Okay, next one, number 4. General expenses accrued. If general expenses accrued me, no lah, plus lah. So go find a general expenses, you plus 2,400. Plus 2,400. Then go find here, right here, general expenses accrued. General expenses accrued 2,400. General expenses 2,400 accrued. After that, we have another one. I think this is the correction of error. This is the error. This is the error. A computer costing 8,000 had been recorded in the computer maintenance account. It's a mistake. By mistake, they record this. So we do the correction. So the correction is actually computer. They go recorded in the maintenance account. So we minus from the maintenance account, you put back in the computer account. So minus from maintenance. Where's maintenance? computer maintenance, we minus 8,000. And then we go plus computer, 8,000. Understand now? We plus the computer minus the computer maintenance. Next one. Next one is depreciation. Depreciation to be charged on all the non-current asset owned at the end of the year, an appropriate amount on the leasehold premises. Okay, leasehold premises. I see the leasehold premises, or it's actually what we call straight line method. Okay, I go to the straight line method. Okay, in a straight line method, there's another formula. For straight line method, there's another formula. The another formula is we take the cost, divide with the useful years. You'll get a depreciation also. The cost divide with the useful years. So straight line got another formula. This is the another formula. Cost over useful. How long you can use the asset. We divide with that, then we get a 1 year depreciation. If that particular year you use less than, then you need to times with the how many months lah. Okay, how many months? So cost divide with the useful years, we will get a depreciation under the straight line method. When I see the land here, land or what? Yeah, leasehold premises, the cost is 100,000. And then the lease is 25 years. The lease is for only 20. You can use the particular premises only for 25 years. After 25, you need to give back. Okay, or you sell back to the government or someone else. So we calculate the depreciation for the leasehold. Calculate here. Depreciation of the leasehold premises. How to calculate? You take 100,000 cost, divide with the useful years, which is 25. I get 4,000. That's a depreciation. And then go to the provision for depreciation plus the 4,000. Go to the provision for depreciation plus the 4,000. This is the current year depreciation. This is the last year depreciation plus the current year depreciation. You remember just now I explained? Okay, how to know when to use which method? Okay, normally the question will tell you. You see on the second one, computer, they will tell you. Computer will tell you using a reducing balance method. Office furniture, use a straight line method. Now, most of the time they will tell you. Okay, but for the first one, they didn't tell me, but they say appropriate amount. Then I also don't know which method to use. I also don't know which method to use. Then I go see the question. I see the question. They gave me the cost. They gave me the useful years. So when they give you the useful years, how long I can use the asset, definitely we use the straight line method because that's only formula that we can apply here. You understand or not? Most of the time the question will tell you, but sometimes the question want to trick you, they do this. But if you do this also, when I see the information given to me, based on that, I can select the method. Okay, good. Okay, so next one is computer, depreciation for the computer. For depreciation for the computer, we use a reducing balance method. Reducing balance method. Reducing balance method, you remember the formula just now? Yes or no? Cost minus accumulated depreciation. Cost minus accumulated depreciation, then only times with the percentage. Cost minus accumulated depreciation, then only times the percentage. Okay, now I see the computer. How much is my computer? Or my computer is this one. There's a new computer also. 44,000 plus with 8,000. 44,000 plus with the 8,000. So I calculate the depreciation of computer. 52,000. You know how I get 52,000 now? 44 plus with 8,000. 44 plus with the 8,000, we get a 52,000. 52,000 times minus with last year's depreciation. How much the accumulated depreciation? Another name for accumulated depreciation is provision for depreciation. Another name for accumulated depreciation is provision for depreciation. My last year's depreciation or provision for depreciation is 16,600 times with 30%, right? Oh, sorry, 25%. So 52,000 minus 16,600. 16,600 times with 25%. 8850. That's depreciation for this year, current year. So the current year depreciation plus with the last year's depreciation 8850. Later we will include this in our statement of financial position. Okay, next one. I'm done. Office furniture is 10% straight line method. Straight line method is quite easy. We just take the cost times with the percentage. Take the cost times with the percentage. So office furniture, can you go find our office furniture? Office furniture is 15,500. So depreciation of office furniture is 15,500 times with 10%. I get 1550. 1550. Then that one will be plus with depreciation of the furniture 1550. Very easy. Next one. Trade receivable of 1,900 is irrecoverable. Irrecoverable means the guy cheated us, the guy ran away, or the guy died already. So what we do? We will go minus the trade receivable. Can you go find a trade receivable? 1,900, right? Trade receivable minus 1,900. And then you need to go plus the irrecoverable debt. Can you check, do you have an irrecoverable debt here? If you have a previous irrecoverable debt, we just plus together. We will just plus together. If you don't have, then create a new one. Can I double check irrecoverable debt? No, we don't have the irrecoverable debt. So I create a new one. Irrecoverable debt 1,900. Irrecoverable debt 1,900. After that, next one is provision for doubtful debt is maintained at a 4%. So I need to calculate how much is the provision for doubtful debt. How to calculate provision for doubtful debt? We take the net trade receivable. How to calculate the net trade receivable? We take the 27,900. 27,900 minus with 1,900. 27,900 minus 1,900 times with 4%. So how much? I get 1040. 1040 is this year's depreciation. So this year's provision for doubtful debt. Can you check how much the last year's provision for doubtful debt? Last year's provision for doubtful debt, we check from here. Last year was 910. Last year was 910. This year is 1040. So increase or decrease? Increase by 130. So right here, increase in PDD 130. How much increase? That's what you need to write. Increase by 130. I'm done with the last additional information. So actually we are done with all the additional information, all the adjustments, we call that. Okay, then you can prepare with the new numbers. There are new numbers here. There are new updated numbers, and also there are new item also, new item. So all this will be recorded in the statement of financial position and also income statement. Cannot? Any question? Can I do the income statement? Okay, I will do the income statement now. First, start with revenue. You remember the format of income statement? Revenue, cost of sales, other income, other expenses. Okay, first one, we start with revenue. Revenue is 287,000. 287,000. That's my revenue. Revenue need to minus with revenue need to minus a sales return. Do you have a sales return here? Return inwards is a sales return. Return inward is my sales return. So right here, sales return 3150 bracket, because we want to minus sales return. Revenue is 287,000 minus with the sales return 3150. If you minus, you'll get 283,850. 283,850. Can or not? And this one will be minus with cost of sales. This one will be minus with cost of sales. Okay, your cost of sales is, start with opening inventory. Do you have an opening inventory here? Yes. Inventory at the 1st April. Opening inventory 15. There's someone entering. 15,340. 15,340. Right in a second line. Must write in a second line. After that, we have a purchases. How much is my purchases? My purchases 143,800. So this purchases is supposed to write here to minus with the sales return plus with the carriage inward, and then minus with the goods for own use. So can you check this question? Do you have a sales return, goods for own use, and also goods for own use, purchases return, and also carriage inward? Can you glance through this question and tell me, do you have a purchases return? Do you have a carriage inward? Do you have a goods for own use? Oh, no, nothing. Okay, no, nothing. We don't have anything. So since we don't have goods for own use, so you don't need this. Since we don't have a carriage inward, we don't have this. Since we have a sales return, okay, we don't have this. Then the purchases straight away right here, 143,800. 143,800. No, this is not a service business. Service business don't have purchases. Here we have a purchases. They don't have the purchases written only. If they have a purchases and then they have an inventory. If they have an opening inventory and purchases, it's not a service, it's a trading business. Yes, if you got the purchases return, goods for own use, and carriage inward, you need to write here total up and write in a second line. Okay, this is the first line, this is the second line, this is the third line. That's how I'll call that. That's how I call this first, second, third. Okay, so if you got purchases return, goods for own use, and also carriage inward, write in a third line. This is the third line. Then only go to the second line. But now we don't have, we straight away jump to the second line. And we need to plus this to our opening inventory plus with the purchases 159,140. And this one will be minus with closing inventory. How much is your closing inventory? The closing inventory here, 17990. So I had here 17990, put it in a bracket. Put it in a bracket. So 159140 minus 17990, I'll get a cost of sales. That particular cost of sales you can write here. 141,150. We put it in a bracket because we want to do minus. Then sales minus with the cost of sales. Sales minus with the cost of sales, we have a gross profit. 142,700. That's my gross profit. $142,700. That's my gross profit. You okay not? This gross profit need to plus with other income. So can you check, do you have any other income? Yes, I can see one other income, which is commission receivable. Commission receivable is my other income. Commission receivable is my other income. So right here, commission receivable. Show the working of 4,900 plus must show the working 1,400. Get answer right here. If you got wait, I don't write first. Right here, if you got any other income. If you don't have any other income, straight away right here. So this question I already glanced through just now. They have only one other income. So straight away write in the first line. If you got other, write in the second line, total up and go back to the first line. Can I? Then you plus together 142,700 plus 6,300. I get very good 149,000. 149,000. And this one will be minus with less other expenses. Okay, what are the other expenses that you have? Always from top to the bottom, you see like that. Okay, yeah? Then only you don't miss out anything. Yes, I can see wages and salary. The wages and salary is 26,500. After that, you have computer maintenance. Computer maintenance got calculation. You need to show the calculation. Computer maintenance or computer expenses? Computer maintenance. Computer maintenance is 12,200 minus with 8,000. So you get 4,200. For that, do you have anything else? Yes, rent and rates. Rent and rates 10,000. Rent and rates. Bank interest paid. Yes, bank interest paid is your expenses. Bank interest paid is expenses, but this is a finance cost. All the finance costs must put separately, separate expenses. Later, I skip this one. Later, I'll come back. Heat and light, 7,300. Heat and light. All the interest will be keep it separately. The separate expenses. Advertising expenses got calculation. Advertising expenses 12,600 minus 3,800. I get 8,800. Then general expenses also got calculation. Show the calculation. General expenses is 8,700 plus with 2,400. So 11,100. After that, I think that's it for this side. And here, got any expenses? Yes, depreciation, 4,000. Depreciation of leasehold premises, 100,000 divided by 25 years. Next one, 8850. 8850. That one is depreciation of computer. Show the working hour, must show the working. 52,000 minus 16,600 times 25%. After that, we have another one, depreciation of the furniture, 1550. Depreciation of office furniture, 15500 times 10%. After that, erecoverable debt, 1900. Last one is increase in PDD. Increase in PDD right here. Increase in provision for doubtful debts. That's it. I taken care of all the expenses. What you can do, you can total up. You can total up all the expenses, 26,500, 4,200, 10,000, 7,300, 8,800, 11,100, 4,000, 8,850, 1,550, 1,900, 130. So total expenses 8,4,330 except the bank interest, bank loan interest. So 149,000 minus with 8,4,330, I get 6,4,670. That's my profit from operation. Profit from operation. Profit from operation minus with bank loan interest. Bank loan interest must be after the profit from operation. So your bank loan interest is how much just now? 1,500. So right here, 1,500. So minus 1,500, you get 64670 minus 1,500. Oh wait, something is wrong. Wait, give me 1 minute. $26,500 plus 4,200 plus 10,000. Total expenses is wrong. 7,300, 8,800, 11,100, 4,000, 8,850, 1,550, 1,900, and 130. Give me 1 minute. 26,500, 4,200, 10,000. Oh, wait. The bank loan interest is actually a problem. Okay, can we see the bank loan interest? Oh, this is the hidden, they want to make it this question harder, so they have a hidden message. So there's a bank loan, they gave you the percentage. They gave you the percentage. So if they gave you the percentage, can you calculate how much is the interest? If they give you the percentage, can you calculate how much is your interest? Can or cannot? Can, right? How to calculate the percentage? 40,000 times 6%. Interest. 40,000 times 6%. 40,000 times 6%, I get 2,400. Your interest supposed to be 2,400. Your interest supposed to be 2,400, but how much you paid? Bank interest paid is only 1,500. So minus 1,500, 900 is accrued. The question won't tell you. You as account student need to do this. That's where the A star student and A students different. The A star student will see this and they calculate and then they put. The A student or B student, C student, they don't see this. So the question don't tell you. The question don't tell you. You as a account student should know this. Okay. So there's a loan interest accrued 900. Can or not? Loan interest accrued is 900. So right here, loan interest 1,500 that you pay, 900 that accrued that you haven't paid. So total 2,400. Luckily, I realized now. 64670 minus 2,400, you will get 62270. 62270 is my profit for the year. Cannot? Okay, faster, we'll do the statement of financial position. Okay, statement of financial position will start with non-current asset. Okay, non-current asset, we list down all the non-current asset. Now we have a leasehold, computer, and also office furniture. Just these three, we write here. Leasehold premises, computer, office furniture. Computer got calculation, right? Yes. 44,000 plus with 8,000. This one is fixed 100,000. This one is 52,000. And this one is 15,500. Okay, after that, the accumulated depreciation. So we just need to plus these two, plus these two, plus these two. Actually, I already plus. I just straight with the right answer lah. But you know what? Plus this, plus this, plus this, right? As a accumulated depreciation. And my accumulated depreciation for leasehold is, I plus that one to one, is 11,000. Computer is 25,450. You can double check, calculate yourself. 13,550. I'm done with this. Now you total up. Okay, 100,000 minus 11,000, I get 89,000. 52,000 minus 25,450, I'll get 26,550. 15,500 minus 13,550, I get 1950. Then total up, you double line the cost and accumulated depreciation. Because we stop the cost and accumulated, we will continue with the book value. So whenever you total up, you get 167,500, 50,000, and this total will be 117,500. That's it for my non-current asset. Okay, not non-current asset. After that, we have a current asset, very fast one. The first current asset that you always to write, if you got the question got means you must write the closing inventory. Okay, others all you can mix around, but first you write closing inventory first. Always make it a habit. Okay, so your closing inventory is 17990. So right here, 17990. After that, you can write trade receivable. And your trade receivable is how much? Got calculation, 27,900 minus with 1,900. Show the working hour, must show the working. 27,900 minus with 1,900, you'll get 26,000 right in a third line. Why I'm writing in a third line? Because this one need to minus with provision for doubtful debt. How much the provision for doubtful debt? 910 plus 130. 910 plus 130. 910 plus 130. I get 1040. So 26,000 minus 1040, I get 24,960. Straight away minus and write the answer. 24,960. Okay, how to get this accumulated depreciation? How to get this accumulated depreciation from here? This is the last year's depreciation plus with this year's depreciation. Just now, whenever I read the addition information, I got right here what? Last year's depreciation 16,000 plus this year's depreciation 8850. You just total up these two, you'll get the accumulated depreciation. Accumulate means accumulate. Last year, this year plus together. That's the accumulate. Okay, after this, do you have any other current asset? Can you check in the question there? Do you have any other current asset? Yes. Commission receivable accrued. Advertising prepaid. These two are my current asset. Is my current asset. If you want to write one by one, you want to write commission receivable accrued, advertising prepaid one by one can, but that one is like a low students, normal students answer. But the high class student, the A style student, the very good student, what they write, you know, the normal student will write one by one, but the good student, they will write, they will total up together, they will write other receivable, but they will show the working up. They must show the working. The working must be shown. No working, you don't get the full mark. 1,400 plus with 3,800. The total 5,200. Okay, after that, do you have anything else? Must have bank, right? Yes, cash and bank 520. Debbie said means the current asset. 520 cash and bank. Yes, that's it. 17990 plus 24960 plus 5200 plus 520. Total you get 48670 plus with 117,500. So the total will be 166,170. That's my first balancing. After that, very quick one, we have a capital. Capital, we have an opening balance of the capital. Opening balance of the capital. How much the opening balance of the capital? My capital is 70,000. So right here, 70,000. This opening balance plus with profit for the year. From where you get a profit for the year? Profit for the year from here, from the income statement. From the income statement. So I write here 62270. 60,000 plus the profit 62270. I get 132,270. Understand? Okay, before we continue, there's a question here. What is other receivable? Okay, other receivable means these two. Commission receivable accrued and advertising prepaid. These two you plus together. If you want to write separate one also can. You write commission receivable accrued, current asset. Yeah, these two are current asset. Advertising prepaid, current asset. These two are current asset. You can write one by one or you total up also can. Both also acceptable. Okay, yeah? Any problem? Okay. Okay, drawing. Next one is drawing 28,000. I go here. I minus with drawings. Drawing 28,000. You put it in a bracket. 132,270 minus with 28,000. I will get a closing capital. My closing capital will be, yeah, very good. 104,270. This one will be plus with non-current liability, but I didn't see any non-current liability here. Do you see any non-current liability? Oh, loan. This loan is a non-current or current liability? This loan is a non-current liability or current liability? You will pay back on the 2016 June. Today's date is March. You will pay back after 1 year or less than 1 year. Today's date is 31st March and you will pay back on 30th June 2016, same year. So it's within 1 year, right? If it's within 1 year, it will be in a current liability. Within 1 year means it's a current liability. After 1 year means if you pay back after 1 year, then it's non-current liability. So this question, we don't have any non-current liability. So we straight away write current liability. And then the first current liability that we see just now, 6% bank loan. How much is the 6% bank loan? 40,000. Now, of course, we'll have a trade payable 18,600. Trade payable 18,600. Next one, do you have anything? Yes, I have a general expenses accrued and loan interest accrued. General expenses accrued and loan interest accrued. You want to write one by one? Can. You want to write one by one? Can. But I'm a good student, so I want to show the examiner I'm a very good student. I write other payables and show the working. 2,400 plus with 900. I get 3,300. So if you total up this three, you get 61,900. 61,900. If you take 104,270 plus with 61,900, will total up 166,170. That's a total. That's a total. And normally this total and this total will be same. Okay, this is my statement of financial position. That's it. Okay, I finished the class 1 minute before the supposed time. Any problem you can ask me, no problem, can leave the recording, and then this the scribble answers I will send in the group later. Okay, any question you can ask me, no question you all can leave. Thank you so much. Please love me, please love accounts will love you back. Don't love me, love accounts. Please love accounts will love you back. Bye.